So have you seen the New York Times article? I highly recommend it. And I'm not taking that approach as a mortgage broker and learned how to sell mortgages and talk the talk. I literally came to real estate because as a financial advisor, I started recognizing as my kids became adults that their most important financial decisions, the best way to break free from financial shackles is to make the smart decisions about real estate first. Because like whether you're giving a third of your income to the landlord or to the lender, and eventually that becomes less than a third because everything else goes up, including your salary, but your mortgage stays the same. That and you get all the equity. I mean, we all know all of this, but people don't know this until their parents teach them this. And if their parents didn't teach them this, they learn about it in the news or New York Times. And this New York Times article is talking about how he's looking at the market and saying, hey, based on this, the market crashed in 2008 and it took 9 years. He said it took over a decade. It didn't take that long. Even on his own graph that he shared, it wasn't a decade, it was 9 years. Again, that's also a national average, which I don't know anybody's home that is in all 50 states, one home, right? Real estate's always a local phenomenon. But regardless, he makes this point like, hey, if you buy at the wrong time, you could be underwater for as long as over 10 years. And that's never happened, by the way. The longest was 9 when people were lending money to people without income and without verifying anything. That was a
And
problem. And
it's
thank God.
certainly never happened in the state of Colorado, or at least in
Yeah,
our.
exactly. So I started pulling down data from the Federal Reserve Economic Data website, which is glorious if you like statistics. But I started pulling down information about Colorado as a state and then the Denver metro area and looking not just so my argument wasn't my rebuttal to this that I posted on every social media channel that I'm on. It wasn't discounting his statistics, even though he mentioned some that I disagreed with, but it was the conclusions that he was making. Because if you're thinking of, let's say you're worth $2 million or something, and you're deciding where to invest your money, it makes sense to look at trends. Maybe it makes sense to say, hey, where's the best bang for my buck? And even you might do that within markets. So you might like the idea of real estate, but maybe Saskatchewan is where you want to buy, right? You might look at other markets because they all behave a little differently. But his point was not he wasn't talking about investing. He was talking about where to live, like whether you rent or you buy. And what really infuriated me about that is this is a really common mistake. And I don't think that the writer knew that he was doing this. I don't think he was trying to cause problems, but he's going to his I think the ripple effect of that being in the New York Times is going to be $1 billion. It's going to convince, 100,000 people to wait 5 or 10 years to buy something, and it's going to cost all of them hundreds of thousands of dollars. It's going to be a big problem. So we have to combat this. So his point was that, there might be a better time to buy a home. It's better to wait and rent. And that absolutely drives me crazy because now there are, of course, times to rent, but that should be a temporary solution for people, right? If I know I'm going to be somewhere 12 months or less, or maybe 18 months or less, renting can make sense. There's a good argument for that. It's just not worth the process, and markets in short periods of time aren't as predictable. But his point was like, there's a better time to get real estate. You should rent. Maybe renting is a better whatever. And what infuriates me about that is people treat the housing market, when you're looking at it, whether to rent or buy, like the stock market. Like you can look at analytics, find a good time to buy. I don't believe you can time it that accurately anyways, but even if you could, imagine this crazy, insane world, Marie, where if you didn't have in your possession a folder with some stocks in it, you had to sleep on the sidewalk every night. Every night you don't have that in your possession, you have to sleep on the sidewalk. Now you'd have two choices. You could either buy some stocks so you wouldn't have to sleep on the sidewalk, or you could borrow some from somebody who had more than they needed and give them and pay them for it every night or every month, which is rent. Now, of course, there's no market for that in stocks because you don't actually need stocks in order to sleep indoors. But that's the way people think about stocks and real estate, as if it's similar in that way, and it just isn't. Only if you're investing in real estate. But that wasn't the point of the article. He was literally recommending renting for a while and waiting because he thought, well, you should read the article. I won't go over it word by word, but the idea is like, if that was the scenario with the stocks that I mentioned in this folder, and you had to have them, or you were going to sleep on the sidewalk, clearly, if you were in a pinch, you'd pay somebody to borrow those for a night, because sleeping on the sidewalk is a pretty terrible prospect. But you would immediately try to figure out a way where, like, I need to not sleep on the sidewalk, and I need my family to not sleep on the sidewalk. We need to figure this out so that that isn't a problem for us next month and next month and next month and next month, because the cost of renting those stocks, or whatever, how this metaphor is going to break down eventually, but the cost of renting those month after month just keeps increasing. and there's a fixed amount of it, which is also not true about stocks. But treating it like that is a huge mistake, because if you had that problem, you would be thinking immediately, how do I own that so that that's never a problem for me again? And if I have to borrow money to do it so that I can pay it off, I'll do that because I don't have enough money to buy it with cash, the amount of stocks that I would need. If you start thinking about it that way, it seems ridiculous to rent. Ridiculous, unless you're
Great
if you're a
analogy
professional
too.
athlete. Yeah, it just when you think about it, it's ridiculous. If you're a rock star or a professional athlete and you're making, $500,000 a month or something like that, you can probably make horrible real estate decisions and survive. But 99.9% of us, our real estate decisions have a massive impact. And it's not, we could talk all day about why, I think he's wrong about real estate crashing anyways, because I just don't see how that's possible when there's no inventory, when there isn't enough real estate and people can't do without it. I can't imagine that collapsing. I could be wrong about that because I don't know the future. We might go to war and everything that we're predicting changes. But I'm a huge fan of the idea that I don't know, because that's ultimately the truth. And if you don't believe that about yourself, then you're just in denial, because we really just don't know the future. But I propose that if I don't know the future, would I rather be paying somebody to borrow their stocks so that I can sleep indoors, or would I rather own those? Like, not knowing the future compels me to want to own the things that my family and I need. And real estate is one of those things. Now, if we talk investing, then numbers and data, that's different. But if we're talking about how to keep my family dry when it's raining and warm when it's cold outside, we're not timing markets. We're trying to avoid sleeping on the sidewalk. And that's not something. You don't rent your home. You don't rent the place where you raise your family unless it's a temporary solution, or you're working on a way to get toward home ownership. It is not something you should be looking at with an analytic eye about, when's the best time to buy, when's the best ratio between rates and prices and rents and values. It's there's I used to say in the classes that I teach, I used to say, I'm still going to say it, but I used to kind of rebut people when people would ask me in general, hey, is it a good time to buy a home? I always say, I don't know when the best time to buy a home is, but if you're asking me what are your other options? Are you asking me if it's a good time to rent? I know the answer to that question. It's no.
Never a good
Right.
time to
When is it
rent.
a good time to give a third of your income to somebody who's buying real estate with that money instead of you?
And the
Right.
way rents are right now, it's not a third of your money. And a lot of times, because rents are so high, because there isn't a lot of inventory, so people are finding themselves having to rent. And a lot of times it's 50% of your inventory, because rents are out of control and continuing to go up. In our market, they go up 6% a year. So as long as we don't have a lot of inventory, and I also have a comment about, when is it a good time to buy? In July of last year, rates started hitting above 7. We were around 7.5. And then by fall, we were at like 8.3. And now rates are already down to 7. So we kept thinking and talking about this, and everybody wanted to know when our rate's going to go down. Now, 7 is still not a great rate, but it's a heck of a lot better than 8.3. And maybe it's only going to take another 6 months to get down to 6. But when we were in the 6s and 6.5, it was still affordable to buy properties. And I just did a big study about what our market did in terms of prices dropping, because rates were so high and people, needed to drop prices to help the buyers be able to buy at 8.3%. And so my study showed that our market dropped in the last few months about 10% in prices. So on a $600,000 house, that was $60,000 to help accommodate buyers who were unable to pay the 8.3. Well, now we're down to a 7% and our prices are still low. So one could argue that the prices are the lowest they've been in probably a decade, and rates are still high, but there's an offset in those prices right now that's going to change as soon as the rates drop more. So if we get into the spring market and rates have dropped more, all those prices are going to go back up. That $600,000 property is going to be $660,000 property. So now is still a good time to buy, because even if you're buying at 7%, in 6 months, if it's at 6%, you can refinance. We talk about this all the time, but you're not going to get that lower price on a property at the time when rates are down. So it's
Yeah,
still a good time to buy.
that's a really important point, because so in normal markets that we're all used to, and anybody that's taken an economics class will recognize, the supply and demand crossover. Whatever people who are selling things are willing to sell it for, I'm giving a crude example of this, whatever they're willing to sell it for and whatever buyers are willing to pay, there's a crossover line, and that determines the price of that item in a very efficient market for for products and services. Real estate acts a little bit differently because it's less efficient, which just takes, that's why it takes 30 days or more to close. I mean, it can depend on how much work you've done in advance. Sometimes you can do it in a lot less than that, but it's just a bigger project to move real estate around. But what people are missing about that particular market is that where the market settles, where that crossover happens, what's being measured there is not the value of the home. So that crossover is not $600,000 or $700,000. That crossover point is measured in monthly affordability. That's where the market settles. So if you look at a property today, and let's say it's going to cost you $3,500 a month to own that property, if you're waiting for that to go down to $3,000 or $2,500, it's not going to happen. That isn't moving. That's the piece that moves up with inflation, and the rates and the value of the home balance around that like a fulcrum and a teeter-totter. That part isn't moving. That house, if it costs $3,500 a month now, it's never going to cost $2,500 a month ever again. There's one exception to that, and I'll share that in a second. The what's going to happen if rates go down, it will push the prices up so that you'll have to borrow more to buy that house. Therefore, your payment will be bigger. Your rate will be lower, but you will have borrowed more money in order to afford that house, because it's always balancing around that $3,500 a month. Now that will fluctuate $100 here or there a little bit, but that's where the market settles, is on that monthly affordability. The only way that house that's going to cost you $3,500 a month to buy or to live the only way for that to go down to $3,000 a month is if you buy it and then rates drop and then you refinance. You'll still get the lower rate, but you bought it at the value while the rates were here, bringing the values here. As soon as the rate drops and brings the value, not only do you get to lower your monthly payment, you just captured a bunch of appreciation that becomes a part of your net worth in the equity in your home. And that's real wealth. I mean, it isn't something I would spend tomorrow and go buy a vacation package with my equity in my home. But later on in life, if I need to move out of my home, or I need to downsize, or if I get sick and I need to go into a nursing home and my kids need to use the equity in my house to pay for that, that is very, very real wealth. So like waiting for rates to go down, that's going to push the values up and your monthly affordability won't change. That's the part that's relatively fixed, except it's not fixed because it's creeping up over time with inflation. It's not going to go backward by waiting. It can only go backward if you're able to get it at the price where it is today, because then it stops going up because you own the property. And then when rates change, and this is balancing around you, we live in the only country in the world, by the way, where there is such a thing as a 30-year fixed mortgage. I don't know if you know that. But like even Australia, Canada, first world countries in Europe, they don't do 30-year fixed mortgages. That's a huge advantage, because then if rates go down, I suspect that they will sometime over 30 years, but I don't know the future. But if rates go down, I can refinance and get that lower rate and if I wait for that to happen, that's going to happen when this fulcrum is up higher later. And then it's going to cost me $4,500 a month to buy that home instead of the 35 that I get to refinance back down to 20 when rates switch.
And what all this says, and we've said it several different ways with different metaphors, is that the question of, is renting ever a good idea? No. Unless it's a short term, short term, we're moving, whatever, we're building a house, then renting is fine. But is it ever a good financial decision? No. So as soon as you have enough money to put down on a house, that's what you want to do. And the last house we bought, we weren't expecting to, but we, got a condo, and we didn't really have the down payment. I've got a rental, I've got my primary house, and this one came up, and we bought it a few years ago, and I didn't really have cash available for a down payment, but I had equity in my house. So what did I do? I got a HELOC, a line of credit on my house. I took that money and put it down on the condo. I got a renter in there, and now, I'm cash flowing, because that was three or so years ago, and prices are very different. And that property has appreciated, but I'm in a fixed mortgage. The rent is really low, and I've got a stable situation there. And it just makes appreciation for me, makes equity for me. And when I get around to selling it, I'll have a pile of money there. And same with my other rental. That was a primary that we turned into a rental, and we used the equity in that property to buy our primary property. And this is what you and I want to teach people how to do, how to use the money that's sitting there and dead, just sitting in your house, how to use that to build financial security by investing.
I started looking for data. What the question that I was trying to answer was, because I think what people are afraid of, and it's a legitimate fear, what if I buy the house and it declines? What if I buy it just at the worst time? What's the worst that could happen? And I want to know that. And obviously we can't know the future, but we can look at the past and say, okay, what's the worst that's ever happened? And the question that I was trying to answer was, if you're, I think to myself, like 2 years is kind of the minimum, unless you're planning on keeping the property as an investment. But I always say real estate investing isn't for everybody. It takes a certain kind of person so I'm not saying that everybody should always buy and invest in real estate. I like it. I think it's great, but just some people don't want to be landlords. They don't like the headache. It intimidates them. That's perfectly fine. That's different than owning the roof over your head. I don't think of that as investing in real estate. I think of that as like you found a permanent solution to not sleeping on the sidewalk. You need to do that as an adult, right? That's non-negotiable. As far as I'm concerned, there's just no good argument for not making a plan to own your home unless you're just going to be there for a short period of time. So the question that I was asking myself and trying to get data to come up with statistics was, what is the worst 2-year period of time if I purchased at the worst time in the Denver metro area, and it turns out that in many, I did a 2-year, 3-year, 4-year, 5-year, 6-year, 7-year. So what was the worst 2-year period to have purchased and held it for 2 years? What was the outcome? And then a worst 3-year period. And a lot of them ended on April of 2011. I was doing quarterly stuff. So somewhere around spring of 2011, that was the worst time. That was right at the trough where it was the worst time to have purchased real estate 2 years before that, or 3 years before that. That was the biggest dip in history in Colorado. With it, there was a sharp dip in the late 80s when the oil and gas industry had an issue, but that's a different story altogether. It was very short-lived. It wasn't prolonged. So anyways, the stats that I calculated from all the data, from quarterly data all the way back to the late or mid 70s, was that the worst 2-year period, I should pull this up and look at it, but the worst 2-year period was about 7% down. So that is the worst, by the way. And 83% of all 2-year periods resulted in positive returns. And then the average was like 9.5% appreciation. So here's where I was going with this, because I was thinking about that article in the New York Times when I was going through that data to try to say, this is really bad information, and you're going to cause a lot of problems for people who don't know better than to second guess what's being written in the New York Times. Was the numbers that I was looking for was, what's my worst 2-year outcome, my worst 3-year, and also the average, and also at what percentage, like what's likely to happen. And I think of it like a die, like a game board, like a Monopoly die. You roll a die, you have like a 1 out of 6 chances of having a relatively 2-year experience where you don't have appreciation. But what they don't mention in that article is that 2 years of rent, if you're paying $2,500 a month in rent, that just cost you $60,000 to see. Right? So yeah, it is possible. If you're only renting something, if you're only going to buy something for 2 years, it is possible that it might be worth less. But you're betting $60,000 on that.
Mm-hmm.
And you're giving it to your landlord who's building up all this equity instead of you.
Right.
And it just gets more and more likely of you succeeding the longer you stretch that out. So 3 years is better than 2, 4 years. So 2 years is about the minimum where I'm like, if I were going to live somewhere 2 years, I would bank on at least doing 85% of what's successful 85% of the time, not successful 15% of the time. Now, even though it's not successful 15% of the time, it saved me $60,000 in rent.
Right.
So that,
and you get tax benefits.
Yes,
That's the other piece of it. Well, and I want to tell you about a client. So I have clients that bought 2 rentals in the last 11 years or so, and in Boulder County, and we just sold one of them. They'd like to sell the other one because now they're retirement age. So they've just retired, and I had to convince them, you said, not everybody's going to be good for being an investor, and not everybody wants to be a landlord and things like that. Well, they were totally those people. They did not want to be landlords. They didn't want anything to do with it, but they knew that investing was going to help them in the long run. So 11 years ago, they bought these 2 properties and took loans on them and rented them out. Well, in one of them, they've had the same renter for 11 years. So that's crazy. In the other one, they kept turning over renters, but the entire time they had a property management company. They have never been involved in that house. And at the end of the 11 years, one of them we just sold, and the other one, I know what it's worth and what it'll sell for. They're going to walk away with close to $1 million in profit. So what? Like, okay, that's 11 years. So if you're thinking like, I don't really want to be a landlord, but do you want $1 million at the end of now maybe this is exceptional. It's Boulder County. We've had great returns on our investments, but it doesn't mean that, okay, what about in 11 years you didn't touch it? You paid a property management company to take care of it, and in 11 and the rents covered everything, and you didn't do anything, and you get $500,000. Do you want the $500,000? There's just no reason not to do it. If you have the right people, team to help you and to help you find, if you don't want to be a landlord, how do I mitigate that? And okay, I'm going to make a little less money because I got to pay somebody to do that, but I'm still going to make money. I'm not putting out a ton of money other than my down payment in order to become an investor. And then when I get to retirement age or whenever it is that I want to let go of these properties, it's just a big fat check that goes into my retirement.
I don't want that. I don't want that. I don't want that check. Yeah, sometimes I think a lot of times.
So the bottom line is, though, I disagree with you. Some people aren't cut out to be investors. Well, then we hire that. You say that to me all the time. Like, if you're not good at something, hire it out. Like, we all are good at what we're good at, and then we delegate the rest. So you can still invest in real estate, and it can still be a brilliant decision that you make, and not have to run the whole thing, not have to find the renters, not have to manage the renters, not have to manage the property, not have to be the midnight call for the furnace,
Yeah. But I only got here recently out of finance and accounting for the reasons I mentioned earlier. But sometimes people will hear people like us talking about it, and they'll think like, well, of course you're recommending people buy a home because you're in the industry. And I'm like, well, hold on a second. I think it's more true that most agents and lenders are in the industry because they recognize the value that real estate had in their lives or their families' lives. And they're like, I want to be a part of that in other people's lives. So I'm not telling people to buy real estate because I'm a lender. I became a lender because I want to help people buy real estate. And then a similar thing is true about the investing in real estate. A similar thing is true about the effect that it has on people's lives. Like it's a passionate thing. And then the controversy or counterfactual to that is, okay, if we want to help people buy homes and invest in homes, and you're thinking that we're only saying these things because we want people to do that, well, who's on the other side of that argument? Who wants you to remain in your home and rent your home rent your home from them? Like the landlords, are you going to listen to them instead? Like they don't have your interest in mind. Yeah, they're going to get paid. Yes, we get paid when we help people with real estate, but we came to this industry because we have a passion for it, and we're helping you stop paying the landlord and start paying yourself. What is wrong with that? That's what we do.
That's exactly right. That's all I want to do. All of my friends have kids that are 25 and 30 years old. So my friends, a lot of my sphere of influence, a lot of my database is people who are my age, right? And then I have this whole group now of new clients in my database who are all 25 and 30 years old, because I helped their parents to grow their retirement income. And now they're all starting to retire. I mean, half my friends are retired now, and they are living off of their investments. And so they're handing their kids over to me and saying, teach my kids how to create their own wealth and their own retirement income. So for me to be able to get a hold of these 25 and 30-year-old individuals and couples, it's really exciting because I didn't know this. I wasn't a realtor when I was 25 and 30. I was working in corporate America. And now to have these clients who are young and hungry and might not get a Social Security income like the rest of us, they've got to build their own retirement income. And if they start now, then they'll be able to retire so much earlier than the rest of us, because I only started investing 16 years ago. And I wish I had started when I was 25 or 30 because I'd be in a different place. But it's exciting for me because now I get to work. My kids are 17, so my one son is saying, maybe I should become a realtor. And I'm like, no, you shouldn't become a realtor. You should become a real estate investor. That's what you need. Be a realtor until you get enough money to buy your first house and then keep that going, because really that's where you want to be in this next generation. And I've got twins who may not get Social Security income either. So I'm really invested in my kids understanding how to build their own wealth.
Yeah, the best security is competence. Teaching them to become competent adults. Yep.
Well said. It's
Okay.
great. Thanks for joining me. And we are Brady Mullen and Marie Jacobs. I'm with Liv Sotheby's Realty. And we're just so happy to be here and happy to educate and happy to serve our public. And really,